Imagine executing a flawless smart money concept entry. You map the order flow and watch the price hit your target with surgical precision. But then you check your balance. Your net gain is exactly $2.40. You have barely covered the cost of the electricity used to power your monitors. For years, brokers sold the idea that you could conquer the global financial markets with the price of a decent dinner. Today, the math behind that marketing is completely obsolete. Entering the market with $100 in 2026 creates a psychological death trap where the emotional cost of trading small exceeds any potential for real financial gain. The problem starts in your brain. Spending 3 hours analyzing charts to earn pocket change doesn't trigger your dopamine reward system. Instead, it breeds intense boredom. That boredom inevitably leads to the revenge of the micro account. You start ignoring rules and over-leveraging just to see a dollar amount worth your time. This is a chart showing market volatility in the G10 currency pairs. Since 2022, the data reveals that volatility has climbed by 14%. Wider price swings mean modern intraday trading requires wider stop losses. A tiny balance simply cannot absorb a 30-pip stop without violating the standard rule of risking only 1% per trade. An undercapitalized system essentially guarantees collapse under modern conditions, regardless of the technical skill of the person clicking the buttons. As a retail trader today, you are competing in an absolute arms race against high-frequency algorithms and AI-driven liquidity providers. Competing requires professional trading tools, a high-speed virtual private server, and an AI-driven journaling subscription. Those subscriptions add up quickly. If you are trading a $500 account, paying for these essentials drains 10 to 15% of your capital every single month before you even take a single trade. Treating trading as a hobby rather than a business with fixed overhead guarantees a slow, invisible bleed straight to zero. Beyond overhead, professional trading is ultimately a strict game of mathematical probabilities. Even elite strategies with a 40% win rate eventually hit severe losing streaks. This bell curve highlights the drawdown valley, a statistical reality of 15 consecutive losses. On a $100 account, risking 3% destroys 50% of your balance. But a properly funded account, maintaining 1% risk, absorbs those exact losses seamlessly. Longevity in the market depends entirely on having the mathematical capital buffer required to withstand the drawdown valley when it arrives. To build that buffer in 2026, professionals use the hybrid capital model. This diagram breaks down the required $1,500, showing how it must be segmented into 3 strict allocations. The first $500 goes into a personal retail account called Your Laboratory. Because it is your own money, there are no restrictive rules. You use it purely to forward test your strategies and gather data. The second $500 funds your income engine. This cash is used to purchase prop firm challenges, giving you access to $50,000 to $100,000 of other people's capital. Look at the difference in returns. A 10% gain on your personal $500 account yields $50. That exact same performance on a $100,000 funded prop account yields an $8,000 payout. The modern retail edge lies in using personal funds as a point of entry to unlock institutional-sized capital through funding models. The final $500 serves as your runway. It acts as an emergency risk of ruin buffer and covers 6 full months of those mandatory operational tools. The fantasy of taking a single crisp $100 bill and compounding it into $1 million is definitively over. Surviving 2026 requires trading like a professional fund manager, moving away from the habits of a casino gambler into the role of a business owner. Success relies on intelligent capital distribution. If you are ready to build your laboratory and test your edge, head to FXNX to open a zero-spread account today.